In 2019, Uber, the popular ride-sharing app, is set to become a public company, undergoing what may very well be the largest IPO in US history. It's just one of the big names lined up to begin trading on stock exchanges this year. And as an investor, you may be wondering how you can go about receiving some of the first public shares of these promising ventures. After all, who wouldn't want to invest in a growing company early on? But it's important to understand the IPO process before you commit to buying a company's first public shares. Because, as you'll soon see, it's not always ideal to buy a company right out the gate. There are a lot of risks involved with IPOs, and more times than not, you'll be paying a premium price for a piece of the profit pie, while simultaneously handling some unique disadvantages. Why? Well, let's find out on today's Plain Bagel. Initial public offerings, or IPOs as they're commonly called, are a process in which the owners of a business sell shares of their company to public investors, who in turn can then trade the shares with other investors on exchanges. It's essentially the first time that individual investors like you and I can purchase shares of a company. And it's a big deal. An IPO for many is proof that a firm has made it and finally stands as a legitimate corporation. But there are a number of steps that must occur before a stock can be sold publicly. Firstly, the company must hire an investment banker. Now, I know that title gets thrown around a lot, and people sometimes confuse an investment banker with an analyst or an advisor, but an investment banker is an individual or group of individuals who first and foremost help companies raise capital. And in the case of an IPO, they will work with the company to ensure that they get as much money as they can from the share issuance. After all, the primary objective of an IPO is to raise money. So the banker will help with both IPO administration and marketing. The investment banker also underwrites the stocks, meaning that they will be the ones who actually sell the shares to investors on the company's behalf, sometimes with an associated guarantee that a certain dollar amount will be raised. Once the two parties have agreed to the underwriting terms, the second step is for the company to file a registration statement with the Securities Exchange Commission, or SEC. The statement will include information about the company's operations, finances, management, etc. And the SEC will investigate the disclosures to ensure that they are accurate and that the company in question is competent enough to trade publicly. If everything checks out, then they'll set a date for the company's IPO. Step number 3 is to create a prospectus. Here, the investment banker will compile information about the company, including financial performance and expected future operations, and consolidate it into a document for potential investors. The investment banker and the company will then circulate the document amongst institutions and individuals with money to invest, a lot of it, hoping to generate interest in the IPO. After marketing the business, the company then allows interested investors to submit indications of interest, basically letting the company know how many shares they want to buy. And once the company has an idea of what people are willing to pay for their stocks, they'll set the IPO price, the amount the first public investors will pay for their shares. The company will also finalize its IPO allocation, confirming how many shares each investor will get. Now, sometimes an IPO will be oversubscribed, meaning that the demand for shares is higher than the number of shares being sold in the IPO. And when this happens, it means that some investors will only get a fraction of what they asked for, while others will be left with nothing. But alas, with all regulatory requirements met, an IPO price set and subscriptions confirmed, the IPO date comes and the company sells their shares as per their allocation, celebrating their success with the ringing of the exchange bell, an honor that notable IPOs receive, and a very euphoric moment for those involved. At this point, after some further book building, the investors who received shares are able to trade them on public exchanges, thereby generating the stock's first market price and thus concluding our IPO process. So that's how a stock becomes public. And at first glance, the process doesn't really appear to set off any red flags. Even still, many investors refuse to participate in IPOs, arguing that from a value perspective, the stocks are typically too expensive when they first enter the market. In fact, a number of studies have highlighted that at an aggregate level, IPO shares tend to underperform. Why? Well, recall that the primary objective of an IPO is to raise money. That means that the investment banker and the company are going to try and get the highest price for their shares. After all, the owner is effectively cashing out all or at least part of their ownership. So naturally, they would want to sell high, something that goes against an investor's objective of buying low. But it's not just the company's wishful thinking that increases their IPO price. there are explicit factors that generally make IPO shares more expensive than shares already on the market. Firstly, as we mentioned earlier, the company and the investment banker actively promote their shares during the IPO process. In fact, many companies carry out a roadshow when circulating their prospectus, like an actual roadshow, going around to potential investors and attempting to create hype around the stock like a politician campaigning for office. During this roadshow, the company will be advertising that it offers a once-in-a-lifetime opportunity and using generous projections to sell its IPO. A successful roadshow will allow the company to inflate its IPO price, especially if the IPO becomes oversubscribed. Another reason why IPO shares are generally expensive is that the business owners are more than likely only going to sell the shares in a favorable price environment. You see, the business can delay or even cancel its IPO if the markets aren't favorable. So if the owners believe that they can get a better price for their IPO next year, they can simply hold off on the issuance. This makes it very difficult for an investor to find a bargain among IPO shares, since the seller can wait for a higher price before launching their issuance. So IPO shares have a few factors that can inflate their price, but that's not the only problem investors face. IPOs introduce a number of unique risks and disadvantages too. Firstly, there's a large information gap between the buyers and the sellers of the company here. While the stock prospectus helps highlight important details, there is a very limited range of historical data at the investor's disposal, making it difficult to analyze the company. The owner, on the other hand, has insider information and may know something the investors don't, whether that be a potential risk with future operations or some undisclosed issue with the firm's finances. Secondly, individual investors like you and I are at a particular disadvantage with IPOs in that we often can't get access to the IPO allocation. You see, the majority of an IPO shares are generally allocated to large institutional investors, making it very difficult for an investor to receive part of the allocation. The only way for a small individual investor to receive an IPO share is if they go through a brokerage that happens to secure part of the allocation. And even then, they'll have to compete amongst other, potentially larger retail investors for a piece of the share subscription. Now, you can certainly wait until the first trading day to buy the stock on the market, but if an IPO is oversubscribed, you can bet that there will be plenty of other buyers waiting for the stock's debut, which could boost the stock's market price, what you'll end up paying high above the original IPO price. So does all this mean that investors should avoid IPOs? Well, not necessarily. Some stocks do very well after an expensive IPO. Netflix and Google, for example, have earned decent returns for investors who got in right away. Other companies, however, have demonstrated that the hype of an IPO may not be enough to sustain a stock's price level. Snap Inc., for example, which IPO'd at a price of $17 in 2017 and increased to $24 on its first trading day, is currently trading below $10 a share. So, as with most things in investments, you simply need to be aware of the risks and make your decision on sound analysis. If you want to buy an IPO share, reach out to your broker to see if you can submit an indication of interest. Read the prospectus and find out what the money from the IPO is going to be used for. Identify the risks you'll face from buying early and weigh these against the stock's growth potential. In the end, it's impossible to know whether up-and-coming IPOs like Uber will over or underperform. And it's easy to get caught up in the hype surrounding these companies. But it's important to recognize the added risks and remain objective when enthusiasm runs rampant. Like Buffett says, be fearful when others are greedy and greedy when others are fearful. Thanks for watching. If you like this video, make sure to hit the like button. And if you like what we're doing here, hit subscribe. Hit the bell icon if you want notifications about future videos. If you have any feedback or topics you'd like me to cover in future videos, leave a comment down below. For the Plain Bagel, my name is Richard Coffin. Thanks for joining me today.